The next activity we're going to do on the videos is a accrual to cash adjustment. And you'll see attached to this video a document, which is going to be Procter & Gamble's financial statements. What you'll see is the balance sheet is at the top of that financial statement, and the income statement is at the bottom. And so what we're going to do is address two questions. And the first question we're going to address is how much cash was collected from customers? And we don't know that from looking at this set of financial statements. We know what sales revenue was, and we know how much cash changed if we look at the statement of cash flows, but we don't know how much cash was collected from customers. But using T accounts, we can figure this out. So I'm going to give you the model to use to help set this up. So first of all, especially in this system, we're going to have 3 T accounts. Okay, and we know one of them is going to be cash because that's a number that we want to know. And so this is when we get to the end, our answer will be here. If we look at revenues on the other side, well, this is cash. This is revenues from customers, and what we want to do is take the revenues from customers and convert it to cash. But what goes in the middle? What account from the balance sheet is very related to revenues and to cash? Well, it is accounts receivable. So for a company like Procter & Gamble, where most of the sales to probably grocery stores are on account, I would hazard to guess that almost all of their revenues end up at one time or another going through accounts receivable. So we know this is the structure we're going to set up. We also know something else. We know the beginning balance in the accounts receivable. And if I look at the beginning balance in accounts receivable, it is 6761. Okay. And I know the ending balance in accounts receivable is 5836. Two things I want to point out here. Accounts receivable is always a debit balance. It is an asset, and so it is a debit balance. Okay? So with this in mind then, we're ready to rock and roll. All right? So let's start with this process. When a company receives, let's say a company has cash sales, and let's say the company has sales, and let's say all their sales go to accounts receivable at one time or another. What's that journal entry? Well, it's accounts receivable, and in their case, for Procter & Gamble, it would be 79029, and it would be revenues, right? For 79029. And I pulled that number right from the income statement there at the bottom of the page. Well, let me post this into my T accounts. The revenues are 79029, and the other piece goes here, 79029. And what you can see is we both have a credit in our revenues and a debit. So once we get our balance sheet account set up, then we can start to plug these numbers through. Okay. Then the next question is, well, what credit number makes this T account balance? Well, it's some number X. And I know, if I do a little bit of algebra, 6761, my beginning balance, plus 79029 minus some number X equals 5836. And I'm going to tell you, I highly suggest that you always use this algebraic formula to calculate what the X is to help you not make mistakes. And running through this, calculating all this out, I've calculated that X is equal to 79954. So what that means is 79954 makes this balance. Okay, that is a credit. So I need a debit to go along with it, and it goes right here. 79. me erase that. 7954. And there is the answer to my question. How much cash was received from customers for the year? 79,954. All right. In the next video, we'll do a similar question with regard to cost of goods sold.